There's an index committee between S&P Dow Jones indices and MSCI that go through the sector classifications every year. And it's based on where companies are generating revenues from, earnings from, what the market perception is. That's done by consultation. And what we found is with the evolution of the ways that people communicate, that a lot of the stocks that are in the technology and consumer discretionary that use the internet are places where people are forming communities, and they're really communicating that way. So it's been time now where we're going to do the migration, and it's pretty well known. So while it's big news, it's not really new news. And for composite investors, it doesn't really matter. It's sector investors.
But why are you really doing this? I mean, I can think of a million reasons that I could go back through and say it doesn't make sense for this company to be in this sector or this one to be in that sector. I mean, is this because these stocks were having a huge outsized influence on the tech sector where they were trading?
It's not so much weight. There's still a huge weight in technology. It's still over 20% of the S&P 500. Only 5% is moving out. So the sector is dropping about 5%. But what is happening is that, for example, this quarter, you have Apple's the best performer in the 500 and Facebook's the worst. There's this divergence. The revenues aren't coming from the same place. Selling iPhones is different than getting advertising revenues.
So the changes roll into effect. You think most investors know about it, but if you're an ETF investor who hasn't maybe been paying much attention, what would you tell people?
If you're an ETF investor that invests in sectors like technology, then you should pay attention, because there are stocks that are coming out of the tech sector, stocks coming out of consumer discretionary, which is also really popular. You know, you've got Disney and Comcast, big names coming out, Netflix, into the telecom. So you need a combination of technology, communication services, and consumer discretionary in order to get a similar exposure to what you might have had before.
I would say this, going back to this summer, for those people who like to look at sector spiders to invest in, there has been an XLC, that's the ticker of the S&P Spider Communication Services ETF, which is kind of given people a little bit of runway, to your point about being able to invest in it or kind of get an idea of feeling it out.
How's it done?
It's done pretty well. I mean, it has, with the exception of obviously Facebook and whatnot. But the idea is investment vehicles are now put into place and have been in place for a good amount of months here to let people kind of maybe make that easy transition from just straight tech or straight discretionary into communication.
And the new sector is going to, it's like 40% Facebook and Alphabet.
Right. I mean, that's
so
when it's still market
kind of dominated
weighted,
by the FANG-like stocks.
Right.
All right, Rich, let's just talk about the markets overall. S&P 500 and the Dow closing at new highs yesterday. Mike did a report earlier where he said, look, this is kind of shaping up to look like this time last year, which if that's the case, it suggests that things could really heat up in the fourth quarter.
Yeah, you know, Becky, I think profits, not politics, ultimately move the market. And, you know, corporate profits have been strong. And people just don't want to believe that that could possibly be the case. And I think that's ultimately what's moving the markets here is a very good corporate profits, corporate environment, and why wouldn't the stock market take part in that?
But can I just, okay, but it's based somewhat on the economy, okay, and something's going right with the economy, which may or may not be based on policy. So I want to actually just focus you on something for a second, because once again, you sent me something yesterday about, you know, no tax cut has ever paid for itself. So the Atlanta Fed went to 4. Right. 4. So we had a 2.2 and a 4.2, and then do you have a view on what it'll be this quarter?
No.
All right, let's say it's above 4.
Yeah, okay.
So that's 8.2 plus 2.2 is 10.4, right? I'm just getting, okay.
It's okay, keep going.
Will we do 3% this year?
We could. We could,
we could. I just got you to 12%, or to 10%. So unless we go in the fourth quarter below 2, it's going to be the first. Okay, so that's good for you, right? But that's helping the stock market?
Of course,
okay,
Joe,
what about next year?
But wait, why?
Well, just give me next year. What do you think next year is going to be, Rich?
The key thing is that nothing is different about this cycle. What did we do? We just cut taxes.
Okay, fine.
Let me finish.
Will it be a long-lasting higher level of growth, or is it a front-end loaded?
Oh, I see what you're saying. So is it a sugar high?
Yeah.
That's basically what you're asking.
What's next year going to be? I want to hear from you so that next year I can talk to you and say you said it wouldn't last, or you said it would last. Which?
You know how you know that people are worried it's a sugar high? They're talking about tax cut 2.0. That's how you know that people are worried that there's a sugar high
Well,
coming.
that's just making it
and they
permanent
won't.
before they.
Okay,
Well,
but
that's-
you're
that's
not
part of
answering
what's
me.
going
Is it
on.
what's going to
So-
happen in
so
2000? You
I think
conceded
the
3 this year. What
the
about next year?
probability? I personally do not believe that we are doing anything different than before. What you were seeing is perfectly normal. You cut taxes, you spend, market goes up.
Nothing to do with
And so-
deregulation. You don't see any consumer confidence. You don't see any
I
business
mean, realistically, there's no credible evidence that less deregulation causes a stronger
less
economy.
regulation.
Less regulation causes.
Really?
Look at Singapore. Singapore is the most regulated economy in the world.
That's not apples to apples.
I'm not saying.
So really, deregulation didn't work.
Wait, who's the guest? Let me talk.
Okay, but just so I can remember this statement you made, deregulation has not been a positive for the market.
It's been a positive. Yes, it's been a positive, but I don't
for
think
the economy.
But that's not why the market's up. The market is up because of very standard stuff. You're spending and you're cutting taxes. That's called stimulating the economy. Why wouldn't the stock market be up?
Because we did it before, not the
It's
stock
that
market.
simple.
I'm talking about the economy. We didn't have a single year of 3% for 8 years.
I don't care about the economy. That's not my job. I care about making money in the stock
All right.
market. I don't.
That's why I ask you whether, because it does matter how well the economy is doing, it does help corporate profits, so it has to go into your thinking.
Of course it does.
Okay.
But I'm just saying there's many things that affect
So what do we
the
do
stock
next
market.
year? In your view, is
For
it a sugar high? You're talking about tax cut?
2019 could be a troubling year for the markets. Why?
You're not
Because
talking
you
about
have
the GDP. I just want to know whether
Yeah.
we can stay at 3%.
The problem for the stock market in 2019 is you're going to have very hard comparisons on the corporate side. You've got very strong growth this year. You're going to have to keep that up next year. That's called hard comparisons. That's going to be tougher for the stock market